It seems like anywhere I go right now, everybody's talking about Mac Minis and Claude Bot from Claude. Everybody is running out the door to buy these new Mac Minis. And I'm not buying the hype. I believe this is just another thing where people go and they overhype it, and everybody wants to be the first one in line to do it. We've seen this with Amazon e-commerce business, with selling, with affiliates. We've seen this with TikTok Shop, so on and so forth. People are going to sell products, sell courses around how to build your Mac Mini with Claude Bot AI agent, so on and so forth, guys. And I'm here to just tell you, let's talk about the stock market. Let's talk about the top 5 stocks that you can benefit from Mac Mini sales, Claude and Claude Bot continuing to sell and continue to get more and more hyped up. So let's get into it. The top 5 stocks that you need to be looking at for an investment purpose that benefit from this whole hype cycle of AI Claude Bot, and these Mac Minis. No, I do not own a Mac Mini, and I will not be going to buy one or buying one when they sell out off the third-party market for unreasonable prices. So here we can see that everybody is talking about it. Whether you're on TikTok, Instagram, Facebook, X, YouTube Shorts, wherever you are, everybody's talking about Claude Bot. Everybody's talking about Mac Minis. And we're not going to be talking about Claude Bot and Mac Minis in this episode. We're going to be talking about the stocks that you can invest in right now to benefit from this crazy hysteria around these products, okay? So, first and foremost, what is Claude Bot and why is there so much hype around it? Well, essentially, Claude Bot is something from Claude AI, and they built it to be basically a personal AI assistant. And people are going and buying these Mac Minis because they're like $500-$600. You can set it up. All you need is a monitor in your MacBook Mini, and they're setting it up to have their Claude Bot, their AI assistant, their AI agent, run emails and help them with their work and their day-to-days and so on and so forth, right? That's the very basics of it. So they're doing that, and it's getting a lot of hype on the internet. People are talking about it all over the place because, oh my gosh, like this new thing, this new creation can now do all my work for me and I don't have to do any work. Well, that's just not true. And that's fantasy. But anyways, that's the real reason behind it. So who does this benefit? Who does this benefit most? It benefits companies like Amazon that have a huge investment in Anthropic, the creator of Claude AI, as we see here. Also, other big investors include Google, Microsoft, and NVIDIA. And yes, 3 of the 4 of these names, Amazon, Google, and Microsoft, are in the top 5 of the stocks we're going to talk about today. So, Amazon being number 1, we will talk about them in a minute, but we have to first talk about the company that this benefits the most. Outside of Claude, outside Anthropic, because you can't invest in them right now. That is Apple. Yes, Apple. Apple benefits most from Claude Bot. Why? Because people want to buy the app or Mac Mini, right? Because they're selling the actual hard drive, they're selling the actual product that you can easily hook up and then run your Claude Bot through. At the end of this video, though, stock number 5, is actually a stock in the UK, not traded on the New York Stock Exchange, but traded in the UK, that is actually doing a similar thing at a way smaller market cap than Apple. So stay tuned to the end of the video for that company because it's going to surprise you, and it's less than a $1 billion market cap, guys. So there could be some opportunity there still, even though it's ran 30% today. So looking at just the charts, we could see that Apple, it could repeat what it did in 2025 with this symmetrical triangle and then have a fall off. But It's holding the 21 EMA right now. And based off all this hype, this could push Apple up to $300 for the first time ever if the markets don't continue to crank down, right? You're starting to see things curl up on the matrix right here. And if we curl up and get a bull trigger like we did here, we could see a very, very big move higher. But let's talk about Apple and the other 4 companies we're going to be talking about in this video. And let's talk about, okay, they're going to benefit from Claude Bot. They're going to benefit from Mac Mini, blah, blah, blah. Ronnie, get to the point. Are these good investments? Are these good opportunities to invest in right now? Are they holds? Are they buys? Are they sells? Let's talk about it. So before we get into everything, all I ask of you guys, smash that like button if you enjoy these types of videos. I want to be making videos way more. So smash that like button to show me you guys want to see more videos like this, out of the ordinary stuff, or analysis on some great companies. Also, if you haven't done so already and you're not a subscriber of the channel, if you want to be, you could do that right now, absolutely free. Just click the subscribe button below and click the notifications bell if you want to get alerted whenever I post or go live. Okay, so. This is ValueSnapshot. ValueSnapshot is a brand new product that we launched, and it's basically run with the opportunity matrix. We go through a 3D process. Discovery, where we discover stocks that we potentially want to invest in, kind of like finding stocks. 2, data, where we look at the financials. We run projections. We look at valuation analyzer. We compare. We run AI reports. We look at recent earnings statements. We look at earnings summaries. And then finally, technical signals, which will go back to this chart and we'll see, hey, are we above the 20, 50, 200-day moving averages? Are we bullish, bearish? Is the RSI overbought, oversold, neutral, so on and so forth? So with access to this now, you get a 7-day free trial to all this, and it includes our community where you get access to our chat rooms, articles that we put out on stocks, due diligence, overall markets, etc. You can learn in here, videos and live streams. And then if you want to upgrade to the inner circle, get all of our investments, get all of our portfolios and all my investments in there. And then there's mentorship as well. So if you want all of that, I will link that in the bio below. And again, it's a free 7-day free trial, so you can try it without paying anything. Okay, so the opportunity matrix, we talked about this. We go through this set of 13 questions. 5 discovery questions, 4 data questions, 4 direction questions. We're just going to talk about these up front of the video, and then we're just going to go through the analysis for the rest of the stocks for the rest of the video. Discovery, does the company have durable competitive moat? And we'll just kind of fill this out for Apple. Yes, they do. Is the company misunderstood or mispriced? I don't think they're misunderstood or mispriced. Is there a clear catalyst that could unlock value? Yeah, Claude Bot and Mac Minis. Does management have a strong track record? Yes, I do. Is the business model easy to understand? Yeah, I think the cycle that is Apple is pretty simple to understand. Now data. Are revenues and earnings growing? Yes, they are. Are margins stable or expanding? Yes, they are. Is cash flow strong or improving? Yes, it is. Is valuation attractive compared to peers? I'm going to say no, based on their PEs and what they're doing right now. And then finally, direction. Is the stock in an uptrend on the weekly chart? Yeah, it's still in an uptrend. Is the price above its key 50 and 200-day moving average? Yes, it is. Is RSI showing healthy momentum? Yes, it is. Is the stock holding above recent support levels? Here's the 21 EMA right here. It is holding above that support level right there. So yes. So you see we get total score of 11 to 13, a rating of a buy, which we still have to look into the company and do a little bit more. But basically, when we run through everything, this is what we want to see, right? We want a buy score, and we want to be able to answer these questions comfortably and confidently that this is a buy, okay? So now let's look, now that we understand the questions, now we can look at Apple and we can look at the rest of these companies. Let's look at the financials. So look at the financials of Apple. We'll do this on a trailing 12-month basis. And we're going to see that margins, free cash flow margins are kind of stagnant. gross operating margins are stagnant and net margins are stagnant, right? 26 to 27, free cash flow 27 to 28, and then operating margin 31 to 32.4. So margins aren't decelerating, but they're also not increasing, at least not at a heavy clip. Revenues are climbing, net income's climbing. That's because they're buying back so many shares. EBIT is climbing, cash flow is climbing. So overall, the business looks really, it actually looks really, really good based on these. I would like to see free cash flow climbing. They're not spending a ton on CapEx. They do have more debt than cash, obviously, but total assets outweigh total liabilities. Shares outstanding are going down. EPS is climbing. So overall, things look good on the financials, but we have to understand, okay, if we run some simple projections, is this a buy right now using a DCF EPS rule of 40 PEG ratio? Let's just go right to the compare all four models. Analysts have this company with current price is $265.46. Analysts have a low of $220, a consensus of that $303, which I was saying $300, and a high of $350, giving us a good opportunity based on analysts of 14% to 32% to the bullish side, okay? Giving us a drawdown of about 17% based on 12-month analyst targets. If we look at a DCF model, we know that Apple's not going to be growing, 5, 10, 15%. They're going to be growing right around that 2 to 5% mark. With Claude Bot Mac Mini, let's just bump them up to 3%. Let's keep them at a 28.3% free cash flow margin. And then let's bump them up to, at the end of a 5-year, let's give them, because the ecosystem is so great, let's give them a 35 times terminal multiple. So you'd be paying 35 times free cash flow at the end of that 5 years. And we get a minus 7.4% downside, kind of aligning in between consensus and the low. So of analysts. EPS model, EPS growth rate is supposed to be way better. I think, pretty sure they're supposed to be growing around 12 to 15% per year. I would drop this down to a 30 target PE, and then we can see that we are undervalued by 8.2%. So based on DCF, we're overvalued. Based on EPS, we're undervalued. Rule of 40, growth is not there. Profit margin is there. We have a moderate rule of 40, and then our PEG ratio being 33, but growing at about 14%. We are overvalued on PEG. So to tie it all together, right now, I'm not buying into Apple, guys. The Mac Mini is only about, I think, $500 or $600. Yes, they can sell a lot of them, but it doesn't break the bank. This is such a large company, guys. This is a $3.9 trillion company, a $500, $600 product selling, a ton in a short span helps a little bit, but not enough, guys. So I'm not running out the door to go chase this company. They would need to get their revenues growing more to really sit there and say either revenues grow more or they pull back. Where could they pull back to? If they pull back down to 230 and then even down here to like 200 area, right around the 200-week moving average, just like they did back in 2025, that would be very, very attractive to be buying in here. Okay. So I'm not chasing this right now. To give you some firm levels based on Fibonacci retracement, I would say 230, 215, and then 205 is where I'll be looking to potentially be adding into Apple or buying into Apple at those prices. All right, guys. Number 2, stock number 2. We're going to go quicker with this one. Stock number 2 is going to be Amazon. Yes, Amazon. So Amazon has invested billions of dollars into Anthropic, which is the creator of Claude AI, a major strategic investor with multiple billions invested in close collaboration via AWS Bedrock. Okay, so we'll get rid of that now. So Amazon, on the contrary of Apple, and for this one, guys, we're just going to look at the chart real quick. It is a falling knife right now. I'm simply waiting for this to complete washing out, maybe come down here. I'm looking for 190, 200 is a good area right now. Anything under 200, I think, is a very strong buy. But you just have to understand based on the financials, okay? Based on the financials here, we are decelerating with our free cash flow margins. So check this out. Net margins and operating margins are climbing, but free cash flow margins are falling off a cliff. Why? Why? Well, I'll tell you why. CapEx is going through the roof. $131 billion, and they guided for $200 billion in 2026. So their free cash flow is going to continue to be dicey, but I believe we've seen this before. We've seen this before back in 2021, 2022. Look at this. So they were good with their free cash flows, and then everything dipped down because they were spending so much money. But then what it do? It bounced right back, guys. Robotics, autonomous warehouses, drones, less employees, all of these things are going to make margins go through the roof. And with the e-commerce business pulling in as much revenue as it does, $717 billion in total revenue in 2025, guys, their net income and their revenue is going to explode. It's going to explode. We're buying in now. We're getting positioned now in this company, understanding that the margins are not there right now. The margins are not there right now, but analysts know it. I know it, and you probably know it. Amazon is a huge moat, and they're spending a lot of money on AI. When they calm down at a $2.16 trillion market cap, and they'll be probably the first company to pull in $1 trillion in revenue by themselves. Once they do that, you guys need to understand that they're going to be severely undervalued, okay? So right now, based on a DCF model, right? Let's see if they're an opportunity or not. Based on a DCF model, they're expected to grow anywhere between 10 and 14%, I would say. We'll just go with a middle ground of 12%. Current revenue is that. And trailing 12-month, they're 1.1% free cash flow margin. They've gotten up to 7%. Over this next 5 years, I do believe the first 1 to 2 years will be tough on free cash flow. And then I think it bounces back big to an average, because I think it's going to explode due to autonomous everything with them. I think an average of 8%. And then I think you should be paying 30 to 40 times free cash flow in 5 years' time. So we'll leave that at 35. And you can see that we're 11.7% undervalued. Intrinsic value is $224. Current price is $201. And you see the lower we go from here, the better the opportunity. And this being conservative as well. You could easily say that they'll get to 10% free cash flow margins or maybe even 12%, guys. And then obviously you see we really get above $300 per share and we really get cooking on how undervalued this company is. I think Amazon is a buy and sleep well at night stock. I think it's easy buy, sleep well at night stock. Wake up in 10 years, 5-10 years, and it'll be worth a lot more than $200 in my opinion. I think you'll beat the markets, the benchmarks. So the low analysts have is 175. Let's look at it like this. The low analysts have is 175. The consensus or average is 284. The median is 300 and the high is 315. So from here, it's 41%, 49%, and 50, almost 57% higher than where we are right now. So overall, based on this, based on DCF, based on EPS, based on Rule of 40, based on PEG, if we run these as well, I think their EPS explodes probably more than 15%. I think you should be paying 30 times in 5 years. So that's undervalued. And then revenue growth rate of 12%. Profit margins are going to expand rapidly, say to about 10%. So Rule of 40 is not really there. They need more revenue, need more profit margins. And then PEG ratio is going to be, again, I think they get up to 15% there. And their current P is like 27. So based on PEG and Rule of 40, not really a buy, but based on DCF and EPS with these assumptions that I believe are pretty solid, you're looking at a stock that should be basically around $300 per share. But again, people are going to be spooked by the free cash flow margins coming down and how much money they're spending. And that's just going to create opportunity in my mind. Okay. Number 3, Google. not only is Google an investor in Anthropic, but Gemini is also able to run through Claude Bot. Gemini is a backend running through Claude Bot, so that is another bullish reason why they could be a beneficiary of this whole fad, I would call it, craziness around Claude Bot and Mac Mini. So, what do we see on the charts? We see that I don't think right now is a time to be buying Google. I can already see this from the charts. I believe that we're going to come down here, basically back to the sweet spot on the matrix. I think that we'll fall, maybe not as much as that, but I do think we will fall, right? And if we look at the fib retracement, we can fall down to 245, 223, or $202, okay? So, yeah, we can fall a lot from 300 right now. So, right off the bat, based on the technicals, I would wait until we fall down in here, kind of establish some support. And then as we start curling out, that's when you could start buying this. You could wait for a bull trigger. You would have been buying at 170 and we ran to 350 basically. So I'm good with that, right? I'm good with that. I don't know about you, but I'm good with that. Instead of just catching this falling knife, you can DCA, of course, but I don't like to catch falling knives. Once this 21 EMA breaks, then yeah, we're really going to start trending down. So based on the charts, I'm not buying Google here. Let's look at, we don't even have to honestly look at the financials on Google. They're really good, really solid, up and to the right. Margins are expanding. They just had phenomenal cloud growth. We already know all that, okay? We already know all that. Let's look at, right, what analysts think. So Google analysts think 270s are low, 352s a consensus, 415s are high. We're currently sitting at $303-ish. Again, I think we go lower before we go 352, 415 based on current markets and where we're at. Based on this growth rate, I think they grow somewhere around 12%. Free cash flow margins are pretty high right now, 18.2%. That's really good. Look, I would not be paying 50 times. That's what people are paying right now. They're paying 50 times free cash flow in 5 years' time. You can see that 25 times or more high growth tech and dominant platforms. Okay, 25 times or more, not 50. So I'm going to go with 35, and that obviously brings us down here, right? That obviously brings us down here on a free cash flow. And it's saying that intrinsic value is 264. Reminder that would be bringing us down in here, down to reality, because it's ran away like crazy. EPS growth rate's supposed to be pretty solid going forward. Give them a 25 PE after 5 years. And yeah, you're slightly undervalued. Actually, I feel like we are probably a little bit too bullish on that. 18, 12, 15. I'd say we go with 13. So that's going to put us, basically a hold, giving us a fair value of 313. This would be, again, 12. And then profit margin. So rule of 40, no. Peg ratio, no. So overall, it's a sell. And I think that's funny that the fundamentals line up with a sell because I think the charts line up with a sell as well. And I love to use in my community and ValueSnapshot when I write up these articles, when I talk about companies, whether I'm selling, and I was selling up here of Google, I'm selling Google up there because I believe that the pullback is going to bring us back down in here somewhere. And I think that'd be a really good opportunity to be a buyer. So yeah, sometimes stocks just get too stretched. They stretch out too much and they need to snap back a little bit. All right, that is number 3. So far, I think Amazon you could be buying here, but Google and Apple, I would be passing on right now. Number 4 is going to be Microsoft. Now, Microsoft has had this rounded top. They had this fall from grace in April, right, of 2025. They had this huge run up and basically did a double top or a rounded top. And look where they are now. We had a bull trigger. We rode this thing higher. We had a bear trigger. We knew that the time to get out was at this time with this bear trigger, and we've been down, down, down since. Now we're coming back to this support resistance area between 345 and I would say 375. You have the 200-week moving average here. You have support and resistance here. I think we come down in this range, right? And then this next rollout, because Microsoft's not going anywhere. They're getting caught up in this OpenAI FUD and everybody thinking they're going to go under and Microsoft's going to have a big fat debt or something like that. If OpenAI goes under, I just don't see it happening. Even if it does, Microsoft will be just fine. So based on the charts, I do think Microsoft looks very attractive after falling as much as it did from 555 all the way down to currently 397, right around 400. But I do believe that it can fall between 340 and 380. I do believe that. So let's look at them. Why is Microsoft bullish? Well, they have strategic investments in Claude, and they're trying to bring it to Azure. NVIDIA is also bullish for this whole thing, but that's not the number 5 stock. I wanted to throw something, not Mag 7 in there, something a little bit different. So Microsoft is solid for this. Basically, all the things that Claude Bot is doing, right, on Teams and through email and Outlook and everything, that's all being run through in GitHub. That's all being run on Microsoft backend. So that's why it's bullish for Microsoft, if you needed to know. So I believe that we might be getting a good deal here on Microsoft. Was a over $4 trillion market cap, now down to sub 3 trillion. Analysts say they have a low of 392, only negative 1% from here, from current price of 397. Consensus is 587, and the high is 675. So 48% to consensus, 70% to the most bullish analysts. So that looks really good. They had really good earnings. There was no issues. They're going to be spending a lot of money as well. If we go in here and we look at the DCF model, right? Let's run some valuations. Again, we don't need to really be looking at the financials here. It goes without saying, guys, that these financials on these companies are really, really good. So maybe not growing a ton and maybe like slightly going lower on free cash flow. Again, that's because they're spending so much money on this AI data center and AI build out. But net incomes are staying in line or growing. Operating margins are staying in line and growing. Revenues are growing. Net income's growing. Gross margins, operating profits, EBITDAs, EPS, cash flow. Guys, it's all growing. It's all growing. So no reason to really get too stuck in the mud about Microsoft and their financials. We already know those are rock solid. So let's see. Revenue growth rate, 12 to 15% is what they've been doing. I believe with everything, 12% is fair. Free cash flow margins of 25%. I think those can expand again, but we'll just go with 26%. And then free cash flow, right now they're at 38. I think 35 is more conservative. And you have 17% undervalued. And this is based off conservative assumptions again. So 466 should be your intrinsic value. What I would want to be paying or less, which we have that, check mark, we have that, and almost 11% CAGR. If we look at EPS is going to show us that they're expected, again, we'll say 13% revenue growth. We'll say 25 PE at the end of 5 years, again, 15% undervalued. So we can just jump right over here and we can just see that they almost have a good rule of 40 score, positive rule of 40 score based on DCF and EPS. They are undervalued around 16 to 17%. The great thing is on this chart is we have a little bit more room to fall. So 345 to 375 is where I'm really going to be looking at, accumulating here, starting to accumulate down here. And if we keep falling, I'll accumulate a little bit more. And I'll really go in with a chunk buy once we get what? Once we get a bull trigger. Once we get a bull trigger, after being in this sweet spot down here, that's when I'm really going to be hitting the buy button. I might nibble in down here, right? But then once we get that flip and that bull trigger, that's whenever I know I'm confirmed and most likely going a lot higher. And that's when I'm really like buying leaps or, really slamming the buy button there. Okay, that's number 4. So Amazon and Microsoft are pretty decent buys right now, in my opinion. Apple and Google are not good buys right now. They're holds. I would say Apple's a hold, Google's a trim or hold. Sell or hold. Number 5. I don't really have any technicals on this or I don't really have any fundamentals on this company, but we're just going to talk about it. Raspberry Holdings, okay? Raspberry Holdings, RPI is the ticker symbol. If you must know, RPI, Raspberry PI Holdings. And basically, what they're doing, let's see. We'll just look at it. I want to see. I doubt we have this on here. Yeah, I didn't think so because it's not even a US company. We have some non-US companies on here, but that one's like on LSE. I don't even know what stock exchange that is. So, yeah. Raspberry Holdings electronic technology computer processing hardware. It's up 36% today. Why do you think it's up 36% today? Well, I'll tell you, because they build Mac Mini-like products. So people can go and basically buy these Mac Mini-like products. Let's see if they have anything here. Yep. Raspberry Pi surges amid optimism over AI demand. Traders pointed to X, where one account holder posted a fun trade idea to go long the shares, citing growing use in AI applications such as OpenClaw and PicoClaw Nanobot, as well as anecdotal evidence of hoarding. Serenity, I know, wrote in a post, everyone has been openly hoarding Apple Mac Minis and we're long Apple. However, they pointed out that Apple is already a $3.7 trillion market cap, plus the company, and argued that product mass buying won't make a dent. Raspberry, however, is a $542 million company. They said, adding that the revenue is material and that it feels like markets haven't priced this in since there have been almost zero mentions about the ticker on X, but maybe product mentions. So that's how we get a 36% pop today. And again, it's still only like a $590 million market cap, guys. And on a chart, this actually looks pretty good. You have a downtrend here. You're breaking out of that downtrend. Now, I wouldn't go chasing it today. Maybe if we have a pullback back down here somewhere, who knows? Have a pullback down here. Maybe you can nibble in for the next ride higher. Maybe this thing really starts going. I don't know. I'm probably not going to touch this one. I'm probably going to keep away from it. It's not even US currency, and I don't really even want to deal with it. But the matrix is down here in the sweet spot and it can curl up. And I believe if you are in the UK and you do know this company or something, or you wanted a new investment or kind of a speculative investment, Raspberry PI Holding could be your play because of what they have and what they do. So there it is. There's the top 5 stocks that could benefit from open Claude and Mac Mini production and sales, so on and so forth. Yes, it was mostly Mag 7 companies. Yes, it just gave me an excuse to talk about Mag 7 companies and how, Amazon and Microsoft are pretty undervalued, while Apple and Google are fairly overvalued and not really worth your money right now, especially with the markets potentially being ready to bleed lower. But there you go. I hope you enjoyed this video. I hope you got good knowledge, and I hope this video was worth your while. And yeah, I appreciate you all. Smash that like button. Do me a favor, and I'll catch you guys in the next one. Take it easy.